David, great to have you today on ET Now Morning. Firstly, David, just wanted to understand, how do you think the markets are going to perceive what once again seems like an escalation between Iran and the US? And I mean, should one read it as a repeat of what played out in the first half of the year?
No, I don't think it'll be a repeat of the first half of the year, because Trump couldn't possibly afford to entertain the possibility of a war in that proportion again, because it would lead to his party being completely defeated in the midterm elections. His actions in Iran are already a total failure on so many fronts that I think he can show his virility by attacking shore-based missiles and IRGC naval compounds from time to time, but it changes nothing to the reality. However, what that reality is that the Straits of Hormuz are going to remain a very unstable area, a choke point, and that the amount of traffic, oil tankers, which is what interests us, going through the Straits will remain probably about half the level that is needed for normal Gulf oil production to resume. At the moment, you've seen liquidation of inventories coming out on tankers. That's fine. That'll be exhausted in approximately 70 days. But I don't think you're going to see the Straits come back under international control. It will remain under Iranian control, unstable, and with a much reduced level of shipping compared to what is needed to move the sort of oil which would normalize oil markets in, say, 6 months.
Okay. David, very quickly, how should one assess flows into India? Because that has been the challenge. What do you think will tilt flows towards India in your sense, and timing of it?
Well, look, India, I mean, is obviously a major beneficiary of weaker energy prices. And I think the energy prices will probably remain about these levels, or kind of maybe $10 more expensive per barrel, and the same for LNG for another couple of months. And then they will start to climb as the problems about supply logistics going forward in the oil market start to rear their head. So you have a momentary window of happiness. That's one thing. The other thing, though, you want to bear in mind that one of the 3 tankers attacked by the IRGC for using the Omani corridor rather than the Iranian northern corridor, one of the 3 tankers was actually bound for India. So India is also vulnerable to whatever the IRGC decides to do to international shipping. So India is not exempt. In a sense, you have a window of good news that'll run out in probably 60 days, and you are still subject to the uncertainties of whatever the Iranian forces do to shipping in the Gulf, because one of the tankers bound for India just got hit.
David, how do you look at global markets, given the fact that, okay, you have a crude which is now again spiking because of the US-Iran tensions. At the same time, you have, from a global perspective, 10-year US bonds which are, which is hitting 4.55, the 30-year hitting 5%. How do you look at that as well?
I look at it with extreme trepidation, as I think you do, by asking the question. Clearly, we have a number of things which come together in the bond market. One of them is the unsustainable nature of US fiscal arithmetic, which is down to President Trump and his profligate spending. The other is that the oil price has gone down, it's not going down anymore. It'll probably increase closer to $90 a barrel within 4 to 5 months. Once that happens, then you've got inflationary pressure again. And third of all, you have the fact that we've had the good news from Mr. Walsh that he's an inflation fighter, but unfortunately that doesn't cure the problem that inflation is already spreading in the US economy and in other economies. So I'm afraid to tell you that the bond market is telling you what you need to be worried about: unsustainable fiscal arithmetic, lower growth worldwide, and higher inflation. And that is not a good outcome, particularly when you consider what's happening in NATO and the possibility of increased military expenditure in areas like Europe, dramatically increased military expenditure. So not good news and good question.
And on one hand, you have the U.S. bonds which are spiking, bond yields which are spiking. On the other hand, you have the Japanese yen, which is weakening. And that's also creating a nervousness in Asia about an intervention that will come in. From both sides, from a global markets point of view or financial markets point of view, these are two risks which are coming in.
Well, I think the Japanese one is a very important one. For a start, the 10-year bond yield in Japan is, I think, at a 30-year record. And the reason it's at a 30-year record is twofold. The Bank of Japan monetary policy is nonsense. They should be normalizing monetary policy and stop looking over their shoulders at the government and at the past, and they're not. So that's why you get a weak yen, because the market doesn't believe they're credible. And then you have the government. I mean, President Trump's fiscal arithmetic is not credible. And Prime Minister Takaichi's fiscal arithmetic is not credible. So you're getting budget deficits which are going to blow out no matter what you try to disguise them. And in a sense, what Japan is a mirror image of the United States, not of the opposite, but of exactly the same problem: unsustainable fiscal arithmetic. And in Japan's case, the supine and rather